All right. Good morning.
Welcome to Nashville. I'm so happy that you're here in person and we're not doing it virtually. So I'm super excited about that.
I know. I like being in Nashville. Although I was thinking it'd be warmer.
I wish. I mean, you probably missed it by a week, but I'm still happy to have you in the office and you should be visiting us more often.
I will. But anyway, the direct flights and the whole thing, it's really a lot to get here. And I am going to check the weather more closely. But so thank you all for joining us. I'm Michael Carlin, president of InterOcean, co-host. Bhavna Kirana, CFA, CPA, partner here at InterOcean as well. So Bhavna, I know you got exciting news. I was so excited on Friday. So why don't you go ahead and share with everyone your great news from Friday.
Yeah, as of Friday, my husband and I are brand new US citizens, and I'm so excited because our journey to the US started about 7 years ago, and it's been such a fun and joy process. We've met so many great people along the way and created our family here in a way, and I feel like we've experienced the best of the America in those last 7 years. And I'm super excited to be a citizen here. One of the quotes that was mentioned to me on Friday was that citizenship is just one of the ways for you to make a difference to a place that you belong.
Right.
And I'm just so thrilled and excited about that. So super excited. And
we love it. We love it. We love it. We're so excited. All right, so let's get cozy. So let's go ahead and dive in. And for those of you that are new, and I know there's several of you that are, let's just kind of talk a little bit about what this format is. This is our quarterly capital market outlook. This has been going on for more than a decade, where we are analyzing what's going on with the market, what's going on with the economy. We are looking through the data so that we can share with our clients what we see, what we don't see, what we expect to see, and how we are contemplating navigating our portfolios as a result of all that. There's such a deluge of information that we're hit with, whether it be from our cell phones or our computers, emails, rumors, speculation, news, whatever it is. And we want to cut through all of that and give you what it is that we think are the most key and important points. We're going to try to give you the information that we think that you need so that you can stay in lockstep with what we're thinking. So I'm going to go ahead. I want to start. I want to share this data. We've got a lot of data. We were strategizing and trying to figure out the best way for us to get this done in an hour. And for those of you that have been with us for a long time, what you'll note is that is a big task. Okay, wonderful. Okay, so here is the capital market outlook. We've got 10 different topics. Some of them we sent in the invitation, so you're familiar with them. Here are some. We're gonna spend so much time on them, Bob, and I'm just gonna give you a little sneak preview of what they are, what they look like. I'm not gonna read them out loud, but we've got to dive into what's going on year to date. Last year, let's not forget that the market, S&P 500, broadly speaking, was down about 18.5% last year. You also had bonds, broadly speaking, down about 13% last year. It was one of the worst years in combination from a performance perspective, which going into this year, we're thinking, is there going to be some kind of a bounce? And indeed there was. So look at the stock and bond, the kind of 60-40 stock to bond performance year to date here at the top. You'll see that we already have seen a 6.2% increase global, or 60-40 US at 6%. Again, it's been a really nice rebound.
Yeah.
I mean, that's also like uncommonly high for a quarter. We're not expecting, we're expecting 6% per quarter or 24% year. That would be a little bit much. We're going to talk a lot more about what our expectations are and why, but it's been a terrific rebound to start the year. These numbers are through Friday of last week, just a couple of days ago. So this is pretty fresh data. What also should stand out is that, the digital assets, which had a really bad week last week, down 11%, but a 41% bounce, as Bhavna and I have been talking about. That's off of a horrendous year last year. We don't have positions in cryptocurrency meaningfully. Those clients that want to play that kind of position were more into semiconductors and things like that. But it's been a great start to the year so far. When you peel back the performance data a little bit more, which we need to do, which we always do, what does the data say? It's interesting because years like last year, you got Meta, which is Facebook, Amazon, Apple, Microsoft, and Google. The performance of those big five, they were down about 22% on the year. Well, the rest of the S&P 500 was down about 9% or so last year. Interesting that the big five performed so much worse, because if you look at the start to this year, it's been a very different story where the big five are up 26%. And the rest of the S&P 500 is, up about 4%, where you're getting the market return about 9% or on the S&P 500 broadly this year. So what we're seeing is that this year's been great, but it's really been led by a rebound in the 5 largest, most well-established, most well-known, consistent brands in the world. And it's not surprising, Bhavna, that when things are, I don't know, more uncertain in the market, that people and institutions will flock to those holdings, and that's exactly what we've been seeing.
Yeah, exactly. These mega tech companies have sort of become the flight to safety, and it's so. I mean, I'm so fascinated with these charts because obviously a lot of times our opinions and outlook on the market kind of ends at that top line, looking at the overall S&P 500 performance. And these charts are so powerful because it actually takes you take a step back and say, what about the breadth of this run-up that we've seen?
Did you say breadth? Because I have a chart on that. Yes. So the breadth is so weak. So this chart's great. It goes back to 2005. And here's the point that we're making, is that this rally that we've seen so far is so very narrow that it's kind of compared on a historical standard. Now, we're not going to draw any conclusions from a performance perspective, but what this does allow us to do is to temper our excitement about the market movement higher so far this year, because it has been so thin. Mm-hmm. It has been so thin. So we need to do a lot more digging, which we will do here in the subsequent slides about what we are expecting. A quick note about bond performance. For those of you avid watchers of the market outlook in the past, you'll know this chart. This is the nearly 5-decade-long bull market in bonds here, which is, again, as the Fed had to raise rates to 15 all the way down. We've broken through that trend meaningfully so. So as a result, we saw really difficult bond performance last year. We've seen some improvement this year as measured on this chart on the right-hand side. And what I'll indicate real quick is that the 2021 performance was negative a little bit. 2022 for bonds performance was very negative. Those 2 years wiped out 5 years of bond performance, and we're off to a better start this year. And that's, I think, listen, there's so much more we could talk about with bonds, but just generally speaking, we think that bonds are in a pretty decent place right now. And we'll talk a little bit more about interest rates.
Yeah, absolutely. Let's talk about the least talked about topic in the recent history, inflation.
Yeah, right. Get out of town.
So the first chart that we have up here on this topic, obviously we want to spend a lot of time on the topic of inflation because obviously it is very, very critical. A lot of the next steps and activities that we'll see throughout the remainder of the year would, again, at least from the Fed's perspective, is very focused on inflation. And if we look at the recent readings, we've definitely started seeing some slowdown and a little bit of a cooling off in the headline CPI as well as core CPI numbers. And, we kind of highlighted the most recent reading here. The headline year-on-year CPI kind of ending at around 5.5%. We've seen the core CPI, however, has seen a little more stickiness. And I think the reason for that is twofold. One is because of the shelter and the rent component in the CPI calculation. And two, the services-driven inflation has been a little more persistent than we would like to see. Granted that in the past few months, energy prices have slowed down. And that's one of the reasons why we've seen that effect kind of trickling through the headline CPI numbers. So it's kind of interesting to see this, the trend lines are definitely in the right direction, but how quick can we get to that 2% goal? That obviously is the biggest question in the room, and we'll talk about that a little
It
more
is.
for the next few slides.
And service is such a big part of the economy. It's just,
Right. And that's the reason why what you see on the screen now is the implied Fed fund rates. And it's fascinating to see how the implied policy rates, just on a month-on-month basis, what we're showing here on this chart is January, February, March, and April so far this year. And look at how much activity and shifting around we've already seen, which is, again, very, very unusual. On one hand, the Fed has been consistently very clear that they will have that higher for longer posture, because again, we just saw in the last slide, inflation numbers are trickling down, but not as fast and not as much as the Fed would like to see. And at this point, at least for the next meeting, the market is pricing in another 25 basis points
for this week.
Yeah, because again, there is still a lot of work that needs to be done to really, truly bring inflation under control. But there are also alongside pockets of the market which are not buying into this higher for longer conviction.
Right.
And we feel that there is a little bit of a disconnect between what the market would like to see from the Fed versus what the Fed is, at least for now, sticking to their conviction.
Yeah, because we would think, Bhavna, that before, I guess I went too fast, but before we would think that, again, because if the market's right and the Fed's going to come down, or the Fed is right and the Fed's going to stay steady, you're going to see two different market outcomes.
Yeah.
With those scenarios, I guess we'll have to wait and see.
Yeah. And and we've already seen a little bit of that kind of playing out so far this year in terms of market expectations and us kind of going back and forth on how we expect the year to pan out. Yes. And where we expect the year to end. I just wanted to spend just a few more seconds talking about, just this slide, the residential real estate market. Obviously, again, we've seen some cooling off in pricing, especially on a year-on-year basis. But I think this chart, again, kind of puts that longer time frame, looking at that longer time frame, puts things into perspective, saying, yes, we're starting to see a little bit of a cool down, but it's not the magnitude of that is nothing in comparison to, let's say, what we saw through the housing crisis, etc. Also because, right now, the one another different factor is the supply of housing is still pretty tight. And there is a very fundamentally strong demand. So when you look at it from a buyer's perspective, the kind of market that they're still experiencing is not necessarily what you would like to see from this chart, meaning there is still, again, they're competing to buy a house because there are so many buyers out there, not enough supply. And that's another data point, which is kind of, again, making that inflation stickiness a little more difficult to get out of the system.
And for those people waiting for like a 2005 buying opportunity, I don't think so.
Yeah, I don't think so.
The banks. You may have heard a thing or two about the banks. This first quarter, we were just inundated with banks and banking information. So, even Bhavna last night, First Republic Bank. Yeah, that was crazy in that, in their announcement, they lost $100 billion in assets. $100 billion in assets. And you'd think, well, I wonder, is that a lot? Sure, it's a lot. Let's go with this quote up here. This is the Morgan Stanley CEO. I thought it was particularly telling, particularly even in light of the First Republic Bank.
Right.
But with the click of an iPhone, 42 billion left one bank in one day. He's speaking of Silicon Valley Bank. To give you a sense of the order of magnitude, in the financial crisis of 2008, one bank lost 17 billion in a week. So the weighted withdrawal, was 20 times what it was then. This is not to be understated. First Republic Bank, I'm not gonna make an analyst call on earnings, but I will say this is that the situation with the bank is certainly more dire today than it was on Friday last week. They are apparently in need of raising cash capital in order to make sure that their balance sheet stays strong, because they are going to have to sell some assets in order to come up with customer demands for their deposits. And with all of that, I'm reminded of what, many people's favorite Warren Buffett would say, we're not through with bank failures. I mean, there's a lot of different headlines out there, Bhavna, and I am reminded very, very, very briefly of the 2008 financial crisis when we ended up getting, that first Bear Stearns bankruptcy in March of 2008. And it was like, well, the bank's not run well, and that's specific to them, and I get that, and I appreciate that very much. But given what we're seeing today, there does seem to be some eerie parallels with Silicon Valley Bank going out in March of this year. The Fed did step in meaningful fashion, mind you, in meaningful fashion, which definitely helps support the market, definitely helps support the banks, and prevented from what could have been a really ugly scenario to unfold. So with all that,
actually, Michael, going back to the last slide, I do want
this one,
the quotes. One, I just want to reflect back on that Morgan Stanley CEO quote, because it just is so interesting to see. And this quote, I feel like kind of transpires into everything with respect to the capital markets now. Everything is faster, has a bigger ripple effect, just because the way we consume information is very different from how we used to. And so everything is more instant and leads to bigger effects, intended or unintended. So I feel this quote was kind of a really good way of kind of putting that in perspective, saying things are just going to happen much more faster. And therefore, the responses from the regulatory authorities would also need to be very fast. And again, this
responded in a weekend.
Right. And that's what I was going to say, that they acknowledge and understand that's the new world we live in, and everything has to happen on a more real-time basis than taking their sweet little time. So at least we have that working out so far based on how they've responded. I did want to spend just a little more time and actually ask you a question saying, can you just break this whole thing down for us in the context of what some of the issues that the banks are facing right now? How does that compare and contrast to, the last financial crisis? I know there are a lot of slides in the section, but I thought, just for our
contextual
listeners, yes.
So thank you. Yes. So let's remember in 2008, the banking crisis was really centered around the fact that virtually infinite number of loans were made to folks that didn't financially qualify for those loans. Bank lending standards were at all-time highs, meaning they would kind of check your pulse and you would get a loan. And people were getting loans and buying houses, and as home prices skyrocketed, lending standards stayed really low, and all of it. So that was a huge issue, again, because as soon as there was a little bit of a ripple in the economy, it just shook both home prices, lending standards, existing loans, and the whole problem was magnified by a larger multiple, because those investments were bundled, grouped, collateralized, grown, sold, and those things that were thought to be AAA didn't have value, and home prices are going down, and it was a series of dominoes. So today we don't have those bank lending standards. We did not have home prices skyrocketing the same way. So there are different, a lot of different things that are meaningfully absent in a good way in this banking situation scenario. I think we'll go through some of those now. Right. So let's talk a little bit about what's going on. Why are people pulling money out of banks? It's not quite the same thing that we had in 2008, but what we're looking at now I think is best expressed by this blue line versus where this yellow line is. And the difference between the blue line and the yellow line is the difference between what you're earning in your bank deposits versus what you could be earning in a United States Treasury. And capital is funny in that it always manages to find its best way home. It's always, sometimes it takes time, but when there's a great source of quality and return, it's not surprising to see people pulling their money out of the bank and buying US Treasuries. We're seeing it. And we also see it globally and nationally here in the United States, most especially with money moving into Treasury-backed or Treasury-invested money markets. We see the money going out of banks and into those Treasury money markets at a rate with which we haven't seen since the financial crisis. So we know where the money is headed. And so what the issue and the challenge is that banks have is that, well, okay, so and now as deposits are coming down, not only do they have to potentially either use their cash reserves or sell assets to give the depositors their money back. But then what the banks are ultimately trying to do, let's not forget, they're trying to take those deposits in and make money on those deposits. The bank's trying to make profits on those deposits. So if the bank, we're watching what banks are doing with lending activity. And guess what? Lending activity is coming down, the largest weekly drop on record. We're seeing this in a bunch of different areas, but it is notable. The drop in loan activity is notable. And why do we care? We care because as loan activity dries up, it slows economic activity. There's
Yeah.
really no other way around it. And that's
Yeah.
one of the concerns that we have is that you can't lose the banks or bank profitability and lose the bank's lending and then expect everything to be fine.
Yeah, absolutely. I would say that one of the unintended, slightly positive consequence of that, there are a lot of negative consequences, but this will create a deflationary effect, meaning
Yep.
credit tightening will kind of amplify that economic slowdown that the Fed is wanting to kind of make sure happens so that the inflation comes under control. So again, in a very unintended way, there's hopefully going to get a little bit of a positive effect of this. Again, we'll talk about a lot of other things that
We would hope so.
are
But the
not.
little, I'll take all the deflation I can get and
Yeah.
to get the Fed to relax a little bit. And just to kind of focus the lens a little bit deeper. What this chart says very, very specifically is that we know where the winners and losers are. We're seeing it very, very clearly. The losers have been the small banks. We're seeing that in the amount of withdrawal activity. And the winners clearly are the large banks. And you can see it by virtue of the deposits coming into the large banks in this chart and in the withdrawals from the small banks as well on the left-hand side. But another way to look at it is, my goodness, like JP Morgan's earnings.
Yeah.
I mean, goodness, you can see that the large banks continue to win. And what's the concern there? So who cares? Well, first of all, we all care for a variety of reasons, but look at this, so you say like, well, who cares? Because 70%, I'm rounding up, of the deposits are with large banks anyway, and 30% of the deposits are with small banks. So come on.
Right.
Well, but look at this. If you look at things like commercial real estate loans, which I have another slide on here in a second, commercial real estate loans are 70% underwritten and issued by small banks.
Yeah.
See, I mean, that is a key and central part of our US economic system, underwritten by small banks. And so when you see lending activity here in small banks starting to reverse course, no, we're not quite in these kind of below the line metrics, but of course we're not, because mind you, we're seeing this loan activity happen, both large and small banks, and particularly with small banks, both combined. We're not in a recession. We've got unemployment numbers that are about as good as they've ever been.
Yeah.
And we're seeing these low numbers. That's why this is, I kind of highlight the concern is that it's an issue. And
again, going back to the last slide a little bit and talking about that a little more. Yes, the smaller, the key takeaway for me from what you just talked about is that we need small and regional banks in the system. They play a very, very critical role in the economy. And again, like we were talking about, how some of this would have the unintended deflationary consequences is because of this very reason, that the outflows that we're seeing away from smaller banks going into the larger banks, it's almost as if the industry is going through a silent consolidation.
Absolutely.
Which
that's a great one.
Which no one really wanted. And again, in the longer term, it will not, it's not the structure that we want for the banking sector or the economy.
Even JP Morgan with their earnings, they still want a strong small bank.
Because they understand and acknowledge that these small and regional banks have a very critical role to play in the system. And JP Morgan doesn't necessarily want to play that role.
No.
Right. So they need those smaller players to coexist with them and that's why we've also seen a lot of activity and involvement by the JP Morgan executives in terms of trying to help these smaller banks as much as they can
Yes.
within the rules and regulations that we obviously have around us, and which again has been very reassuring to see
Mhm.
that they acknowledge that, it's not really about, they're not using this whole scenario as an opportunity to
Tax
grab.
profits, yeah.
Exactly. It's more about, we have to take a pause at what's the most profitable thing to do versus what's the right thing to do for the economy and for the sector.
Yeah, and I mean, that's 100% correct. And let's be clear is that the banks, the big banks aren't set up to hit all the communities.
Right.
They don't have the employee count. They don't have, and so again, that's how our economy is served with the large swath of small and community banks. So this chart is busy. Yeah, I realize it's busy, but there's another issue coming from the banking channel. We know it, we see it, we're sharing it. Here's what the data looks like. We know that when COVID hit, we know that there was a huge work from home contingent. We get that. We've shown other charts in prior market outlooks where we've talked about the fact that in most major cities, that those folks who have left the office haven't come back, certainly to the extent that they were. But here's what's interesting as well is that we're starting to see real vacancy rates spike. Now, I would compare it to, you kind of look at this 2009 as a basis of comparison. And why is because that was when we had the great financial crisis. So let's compare vacancy rates in big cities today versus where we were in like the absolute bottom of the financial crisis. And you're starting to see vacancy rates that are, again, they're all trending higher virtually from, city to city. Houston, by the way, by far leading the charge. Interestingly enough, because I think for many, they assume that that's one of the stronger, but so much more vacancy we're seeing in places like Houston or others, even compared to the great financial crisis. The reason why this is an issue is that that there comes a time when tenants have to re-up on their lease, and some of these loans for those that own the building need to be refinanced. And we know refinancing activity and leasing activity, both of those things are going to be way worse today than they were the last time. So what ends up happening is that you see this, and you saw this is a different magnitude during the great financial crisis, is that banks end up taking those real estate assets back. They don't want to be a landlord to office property. So that's potentially a big shoe to drop. We look at it as potentially an opportunity for us to be buying. We're not there yet.
Yeah.
But that's how we look at things. Okay, so that's the banking system.
No, that was a great wrap up. Thank you.
Am I done? I'm not done. I'm not done. Okay. Well, is the market over or undervalued? What do you think?
That's definitely a question that we're constantly trying to answer, as we work through client portfolios. And the first chart that we have up on the slide here is we've obviously seen some pretty strong months in the market, especially the first quarter has been pretty positive. But has that truly been driven by earnings expansion? And the answer to that is hell no. Look at this chart here. The earnings estimate for the first quarter are constantly declining as we progress through. Again, granted that, we have so far the first quarter earnings season, there are about 20% of the companies that have reported so far, and almost 75% of those companies have come up with better than expected earnings, which is also, one of the factors for that is because the earning estimates have been constantly declining. So we are resetting our benchmark and comparing the earnings that are being reported with that lower benchmark, which has led to a lot of multiple expansions so far this year. It's not supported by earnings growth. So all we've seen is just pricing in the market going up, essentially. Moving to the next slide here, and just kind of setting aside the fact that companies are still experiencing healthy margins, and the reason for that is twofold. One, in the wake of inflation, a lot of companies did get the chance to kind of ramp up pricing.
Absolutely.
And a lot of that pricing power is going to be stickier in nature. We don't necessarily think that a lot of those corporates would come back and say, okay, we'll cut back prices.
Once they get that status,
right. So they have that tailwind. And two, more recently, we've also seen a lot more activity on cutting initiatives, whether it's layoffs, whether it's kind of holding back projects, etc. So just those two items would, continue to support the margin levels that we're seeing so far. So just setting that aside and kind of forgetting about the margins for
Really
a little
important.
bit. It is important though. Taking a more broader view and kind of looking at it from the top line perspective, for example, the chart on the right, it is the S&P 500 price to sales ratio. And again, you can see that we've kind of starting to trickle back up. And if you look at it in a longer term perspective, that multiple is higher. So we do think that broadly speaking, the equity markets are elevated. It's not giving us a screaming generational
It's
buying
not cheap.
opportunity. And again, we will likely start seeing a little more slowdown in the earnings growth. Next chart, next slide kind of talks about that a little more. The chart on the left is again the S&P 500 forward PE multiples, and we have the average line as the yellow line that you see on the chart, and look at where we are sitting right now. We are above that average right now. Again, going back to the point that given that earnings are a big question mark, the prices at which we're sitting at is not something that is screaming at us saying let's go all in. So we do have to be careful about what we buy in the market. So our emphasis again throughout all of this has been look for higher quality, look for things that make more reasonable sense given that the markets are not undervalued by a lot of measures.
You got to know what you own.
Exactly.
Yep.
And then the chart on the right is also interesting because we've definitely seen the earning estimates kind of coming down from the peak. We've seen about a 12% decline from those peak levels. And if we take a few more references from the broader timeline on the history, maybe there is a little more room to grow go in terms of seeing further declines. But referencing back to my point earlier about the higher margins, etc., we may not necessarily start seeing that right away. And the Q1 earnings so far are on track with that.
Right.
We haven't started seeing signs of that just yet.
So Bhavna, when we're constructing portfolios, because this is, I think, key and important, we're constructing portfolios in-house, and the type of things that we're looking for hopefully will shield us and protect us and our clients in the event that things do get a little bit messier.
Right.
So any kind of note or anecdote you pass along, be like, these are the kind of, fortress balance sheet, whatever kind of the ways you look at it.
Right. And that would top of mind would definitely be quality, know what you own. This is not necessarily a time to be an investment hero. So being more.
You mean buy junk? You mean buy junk? I think you mean buy, yeah.
And again, our thinking is that being more moderate in your risk and having a little more focus on making sure that you have hedges and downside protection, etc., built in is a much better and reasonable way to navigate through the market than crossing your fingers and hoping the outcome is the best case scenario.
Yeah.
And I want to spend a few minutes on this chart because it again puts things into perspective in terms of where we are right now with the S&P 500 around those 4,100 levels, and just kind of playing out a few different scenarios. These are not projections. We're basically trying to map out what would have to happen in the market, specifically with the earnings growth, for us to be able to have more room for growth from the current levels. And ideally, you see all these dotted lines on the, on the right end of the chart. Ideally, we would like to see a few more scenarios above where we are, because that kind of gives us the room for more growth and more upside. For instance, we're looking at certain specific multiple levels accompanied by certain specific earnings growth or earning decline scenarios. Again, if you look at the dotted line all the way towards the end of this chart, that I would say is probably one of the extreme case scenarios, saying what if the earnings growth see another 20% decline from the current levels.
Oh my God.
Which again,
I thought we were skipping that.
yeah, no, I mean, I'm in that
I
wider
got it.
picture
Yeah.
in terms of all the different scenarios that
Mhm.
are out there. And one of those scenarios, again, how a little more extreme out there, 12 times PE, negative 20% growth. That's where we would end up at the S&P levels versus super unlikely. But if you look at that, that red dotted line right above where we are right now, that's more indicative of what if there is about a 10% earnings growth, and the PE multiples are around 17.2. And I would say that also is a little bit of a stretch scenario, right?
And that doesn't give us a lot of room.
Exactly. So we're
Yeah.
kind of stretching our expectations a little bit to get to that dotted line. And there isn't really that much room from where we sit on the S&P right now. So so that margin of error is really narrow, which goes back to the point that we do think that from an overall valuation perspective, we are a little elevated.
Yeah.
And we do have to be careful about what we own in the portfolio and how. I think it also actually underlines the importance of being more tactical and actively managing the
Yeah.
portfolio, because it is not going to be an easy environment to navigate through.
So if you've got a question about hedges and all of that stuff, we're happy to do it. And by the way, as we get to this next slide, I'm reminded of the fact that, if you've got questions, you can hit us in the chat, you can hit us in the Q&A. We're seeing some of the questions pop up in chat and Q&A. Go ahead and do it because we're seeing them and we'll try to incorporate it, because one of the questions was about this. How's that for transition? That was pretty smooth.
That is pretty smooth.
Yeah.
And yeah, I just wanted to spend a few seconds talking about the private equity space. We've clearly seen, some cracks emerging. We've definitely seen some slowdown in the valuation levels, and which, from our perspective, we are looking at that as a potential opportunity, saying we would now, start looking more actively for
Absolutely.
opportunities for our client portfolios to see where can we start, positioning ourselves in that space, because, in the recent past, valuations were very elevated and it wasn't necessarily giving us the opportunity we needed.
Yeah, so we're all in for private equity venture capital. It's getting juicier and juicier. So with regard that was a question about private equity. We will, we have the ability to, and we can do alternatives of all kind and variety. And I think just about this point, yeah, it's becoming a lot more exciting and enticing because we're starting to see meaningful write-downs. So we're there, we're ready. We'll let you know as we get closer. Oh, economic activity. So let's just, we've talked a lot about, different data points. I'm just going to go through, this should be pretty quick, a few different key data points, what we're seeing and what that means. There's two different sides of the economy. There's manufacturing and services. Manufacturing makes up about 30% or so of our economy. And we're seeing that here in contraction. Anything below that black line is showing a contraction. So we're seeing our manufacturing sector shrinking. That's typically a behavior that you see, but not always, that comes with a recession. Now, mind you, we were coming off of a recession from the dot-com bubble bursting, where you saw us go negative there in manufacturing. You're seeing it there meaningfully in COVID, obviously the financial crisis as well. So again, a little bit of a concern with manufacturing, but it's not the lion's share of our economy. And then we will fast forward to services, which is at one hot second, we're showing us a little bit of contraction. But this trend is pretty clear.
Yep.
We're seeing the services trend, which is the remaining 70% of our economy, showing in very, very, very small signs of growth. So when we're seeing manufacturing shrinking and the services part of our economy showing meager signs of growth with that trend, we're seeing two economic data points that are not giving us a heck of a lot of confidence that things are going to be reflected very positively in the market, which also dovetails nicely with some of the valuation discussions that we've been talking about. This is, not everything we talk about is negative. This is probably one of the more negative.
Right. And
so buckle up.
Yeah. And on the topic of services, I just wanted to relate it back to that inflation slide wherein we did is that, the services segment is still actively contributing to that inflation staying higher. So I just wanted to bring it full circle.
That's right.
On that.
Well, you ready? Okay. Well, this one, look. You guys, we'll get to all of our conclusions, but I've got to share the data. So here's what the data is just above. This is pretty long dated. This goes back to the late 50s. And what you'll see here in dark blue, this is the leading economic indicators. This is a collection of US economic indicators that are telling us whether the economy is expanding or it's contracting. And there are times where you kind of get below, well below the zero line, we're seeing meaningful contraction in the leading economic indicators. And when you see periods of time where you get really sharply negative leading economic indicator results, it typically comes to the recession. Here's where we were in February. I got news for you. When the March numbers come out, we're going to be down here somewhere.
Right.
So, listen, not that the world isn't over if we do end up going into a recession, and that's fine. There are ways for us to navigate around it.
Yes.
We talked a little bit about quality and balance sheet, cash flow of all the different underlying equities that we own. There's a definite flight to quality that happens. We finally can earn money on cash. Not that that's our greatest investment strategy, but that's part of it. We're holding more cash as a percentage of than we normally would.
We are getting paid to wait and have patience and kind of, again, make sure that we are making the right tactical changes in the client portfolios.
So this is eye-opening, but you should also know that in our history, market history, we have not had the market reach a bottom until we've seen the recession.
Yes.
So
that's that.
So that we're seeing something like that come, and this shouldn't be a surprise. Then when you have all these different pieces, the small business indexes and the small business surveys give us a window into, because again, the big publicly traded companies, not that they don't represent the country, but still the largest employer of people nationwide are our small businesses. And if you're looking, you're seeing, they're saying there's less access to loans and business optimism is falling. Less business optimism now than at the depth of COVID. This all goes hand in hand.
Right. And again, it goes back to the conversation we were having about the role these smaller banks play. So there is definitely that clear correlation between what happened, some of the recent events in the banking sector and its side effects on the smaller banks, and that clearly directly kind of flowing into the small business optimism index. So all these charts and data points from my vantage point, they just are actually telling us a very cohesive story.
I think so. Oh, by the way, we got more. Keep your questions coming. I see them. So that's great. All the questions are good so far. And if there's a bad question, I will call you up.
Okay.
I'm kidding. Not you, them. Just kidding. I won't. Just keep the questions coming. They're all good. And we will try to get to them as well.
Right. And I know this next topic that we have on the presentation is a question that we've been getting a lot in the recent weeks and months. So we wanted to make sure that we actually have a whole section just on this topic. Is it time to go all in gold and commodities? Is kind of just the broader thing we wanted to address through this segment of the presentation. And what I have on the screen right now is, again, taking that longer term perspective on what the gold has typically done in comparison to the interest rate cycles. And typically
because they're linked.
They are linked, and you can see those big numbers in green, kind of highlighting that at the end of hiking cycles have typically been a positive environment for gold. And we've kind of seen that kind of playing out in the past already. So far, we've seen gold kind of ramping up from its low levels and sort of starting to reach new highs. But there are a few other things that I want to highlight, and I kind of went back into this chart and put this big round red circle around one specific aspect that I wanted to highlight more is that there is a negative correlation between gold and real yields.
Yes.
And would we see negative real yields continuing on for much longer? Maybe not. And maybe, we are inching towards, because again, if everything works out the way it's expected to work out from the Fed's perspective, inflation should peak, coming down much lower. We still have higher rates for a little bit. So I see, the real yields scenario a little more likely than we continuing to be in the negative real yield. So from that perspective, it may not necessarily provide the best case scenario for gold to continue to do well over a longer period of
And
time.
it's the kind of thing, Bhavna, that we would like to, if we do express it, if we buy the gold or gold ETF or something like that, it's more like a trade,
Mhm.
more so than a long term, because you're not getting the dividend, you're not getting any real.
Right. It doesn't pay any dividend. It actually has a cost of carry. So it isn't necessarily it doesn't deserve a long-term big allocation in client portfolios. Can we have some exposure to gold? Again, in a tactical fashion, absolutely we can. And we do, at certain places in some portfolios, we do have a little bit of an exposure. I wanted to spend some time on this graph, which is, a shorter timeline, pointing out a few interesting events that have kind of unfolded. Two things that jump out to me. One, gold prices have kind of reached back to the levels that we saw at the peak of the Russia-Ukraine war. But the other thing, that in between, there were a lot of situations and scenarios wherein gold should ideally have done better. And the reason I think it didn't was because as a currency hedge, it has competition now.
It sure does.
And it goes back to the very first slide that you pulled up in the presentation, kind of highlighting the digital assets. That is, another option out there.
If you don't like the banks and if you don't like currency, crypto is an answer for some, where it used to just be gold.
Right. And that's why I would say that probably we haven't seen the kind of ramp up people would have expected in gold prices in a more traditional environment, because there are other alternatives out there now versus gold being that have that.
The ultimate fear on the index.
Right.
Yeah, I get that. All right, I'm going to go to the next one. Here we go.
Yeah, this chart again, we want to talk about commodities in general. So it does take a wider view, not just on gold, but also on energy, commodity futures, real estate, etc. Gold has performed well. It's typically helped by weaker dollar, which we've seen, that strength in dollar, which was kind of the big theme last year, isn't the case anymore. The broader commodity futures actually lost so far this year because it is hurt by a slower than expected China opening. And that is actually a very, very important big factor now when you actually look at what the commodities end up doing over a period of time, because a lot of the supply does come from China. So
in demand too.
The demand, right? The next chart, again, interesting that we've actually started seeing slowdown in the rig count increases because commodity prices, specifically gas and oil prices, have rolled over a little bit. And from an industry perspective too, the oil and gas companies are going through can be actually a very confusing environment, because there is obviously a lot of policy related decisions that are being made for the industry. There is obviously we had the war situation in the background that created a big issue for the supply, etc. So that I feel like the businesses in this sector are actually at that point wherein it's a slightly confusing environment for them, saying, should we continue to go all in and actually make a lot of investments or not? And what we've seen recently is there is actually a little bit of a slowdown, and they're kind of on a holding pattern, saying we not necessarily want to keep committing more resources to it without knowing, the longer term outlook on things.
Way to weave around that political situation. Yeah. Okay, so we're gonna scoot. We're gonna start scooting. I mean, I don't know where we are on the time thing, but it can't be great. Great. So okay, but this is super important. We're gonna talk about the consumer real quick. I'll just try to shoot through these slides as quickly as possible. And I just want to make sure we highlight the fact that the reason why the consumer is important, the reason why we talk about the consumer in virtually every single market outlook ever, is because as the US consumer goes, so goes the economy, meaning in that consumer spending does make up 70% of our total economic output. So we've got to watch it. So what we're seeing is, yes, inflation numbers have come down. We've talked a bunch about that and why and all of those things, but average hourly earnings have also started to come down as well. On paper, on the right-hand side, what this shows is that on paper, average hourly earnings on a nominal basis, I'll explain what that is in just a second, have risen quite a bit since 2019. So on paper, there are some politicians that may pat themselves on the back that say, this is great, and then people haven't earned this much in a long, this is great, and they can show this chart. But when you take into account the impact of inflation and the fact that the cost of living has gone up, I know every single person who's watching this, whether it be live or recorded, they all have seen the cost of living going up in a variety of different ways. And then on a net basis, adjusting for the cost of living going up, this has been the longest stretch, more than a 24-month stretch of consumers losing pricing power in recorded history. So this is not particularly a great story. So
yeah, inflation is biting through earning capacity, earning power.
It does. And so we're seeing here in gold, this was kind of one of the small success stories of COVID, which was you saw the government step in and there was a tremendous amount of COVID relief money that was given to consumers of all kind and variety. You're looking here at the excess savings. This is really virtually almost all COVID money. And you can see that there's been a tremendous amount month over month spending into and biting into that excess COVID savings amount. And it looks like somewhere around October or so, if this trend continues, the bulk of what was saved during COVID will be out. And the question is this the consumer's dry powder? Is this kind of what has been allowing them to hold on to the spending numbers to the extent that they have been? And we know that with really low to zero interest rates, and we're looking at the cost that people were paying to borrow on the right-hand side, it was so low. The cost to borrow and what people were spending to service their debt was really at all-time lows, which was wonderful,
right.
Multi-decade lows. And the dotted line is indicative of, we're seeing, and I don't have it in this one, but please understand that the credit card balances are hitting all-time highs. The amount that folks are spending on interest payment on credit cards are hitting all-time highs. And so the debt to service, their ability to service that debt is becoming a little bit more difficult in an environment where we know on an inflation adjusted basis, people's wages just aren't there. So let's look at like the total loans outstanding. You got auto and credit cards. I just mentioned it, but this is the total balances. You can see again at all-time highs. There was kind of this COVID reprieve, but we're right back on trend. And if you're looking at delinquencies, this is nothing to like, I'm not sounding the alarm,
right?
But I am saying, Bhavna, you've got unemployment at all-time lows. We are not in a recession. And I'm seeing credit card delinquencies and auto delinquencies already start to creep up, which is something that when you have like a recession here,
right?
That's the kind of action. And we're seeing this trend is disturbing. And it's alarming. It's also, again, just all of this is in relation to the fact that we think that the consumers are running out of gas. That's what this chart's saying here. This is the retail spend. We're seeing some really, it's kind of a choppy number, but we're seeing some numbers that are showing some signs of weakness. So the consumer, which has been our strength, is showing some signs of challenge, which is part, again, of this picture of our valuation in our stance of being cautious,
right.
Given where the consumer is right
So
now.
so far we have inflation is starting to cool off and moving in the right direction.
That's a good thing.
That's a good thing. We do have some leading economic indicators that are concerning.
That's a bad thing.
We do see consumers just losing a little bit of esteem.
That's a bad thing.
That's a bad thing. So what does all of that mean for the Fed's next set of actions?
Just tell us. Just tell us.
Will the Fed pivot in 2023?
Is this like a definitive yes or no? Are you going to give us? Okay, sorry.
If with the Fed pivot, if our thought is that the Fed would just abandon the goal of tightening their balance sheet and let inflation be what it is versus pinning it back down to 2%, I think the answer to that is no.
Right.
However, what we see up here on the screen is there is an override to that answer, and if something breaks, that typically in the system, that typically is, a cue for the Fed to start, changing direction.
Right.
So would the hiking stop and would the Fed be forced to do a pivot because there's something else breaking in the system? We'll have to kind of work our way through this year to figure the answer to that. But again, giving a slightly different perspective on this whole thing, saying, although we've seen a lot of excitement and hope around, we hope the Fed would start cutting rates soon.
Right.
Wouldn't that be great?
I know.
This chart, and the four highlights that you see, it is kind of trying to tell us, again, giving us that historical context that just because the Fed may decide to, cut rates doesn't necessarily always mean great news for the market.
It's not a
either.
time to take confetti out.
Correct. So we also have to remember that when we think ourselves through on what the Fed's next set of activity needs to be in the grand scheme of
Except the
things.
Fed cut, by the way. I mean, like, my goodness, these are all pretty
These-
bad markets.
These are pretty bad markets because we were coming off of a pretty dramatic cut,
Yes.
rate cycle as well.
You're right.
So again, trying to conclude this real quick, a Fed pivot isn't really justified by all the different data points that we're looking at, because it does question their credibility to some extent. If they overlook the fact that, inflation is still persistent and, their job isn't done on that, because at the end of the day, they basically have three goals: stable prices, full employment, and financial stability. And they can't compromise on either of those goals. So, again, my conclusion on this section is that maybe not this year, because we don't necessarily are seeing a lot of data points that strongly supports that stance. So the market may be in for a little bit of a disappointment on whether there would be
Right.
a Fed pivot this
Because
year.
again, the market's expecting about it.
Yeah.
Oh, by the way, there's been a couple of questions. Yes, we do have the slide deck available. We're happy to send it out and make it happen. Just email us if you want it, and we're happy to send it out. But you can't like tune out until you know where Bhavna's 7 to 10 year forecast is. She's going to tell you
Yeah,
Exactly. in 10 seconds.
exactly.
No, I'm sorry. I went too far. I went too far. There we go. Perfect.
And this is a model that we use in house, pretty intuitive and basic for us, using real GDP and an earnings factor as our baseline. Key takeaway from this chart, without getting into a lot of details of how the numbers work, is we really want to see more green in that box that we've highlighted.
Yeah.
And right now we do see more yellows that we would like to see. So our 7 to 10 year expectations, I would say, are modestly below the long-term averages that we've observed. So again, not very excited about the whole situation because of all these different topics that we've discussed. And I know you're going to talk a little more about this in the conclusion section. So over back to you, Mike.
Okay, that's it. Okay. Well, yeah. I mean, well, and again, also with this, I would say, is that this is a chart, goodness, and talk about being done in-house.
Mhm.
I mean, we're happy to share, quarter after quarter after quarter. We've got this going back a long time. So you can see that there's been charts where it's more green, and if the market does come down, then there's more green.
Again, internally, this provides us that sanity check, and it kind of keeps us grounded because we now have the benefit of actually going back quarter on quarter and kind of looking at how the numbers and the dynamic on this table is shifting.
Yeah.
On a period basis, and that actually gives us a lot of perspective too on the markets.
It does. In conclusion,
Conclusion.
I'm thinking maybe it would be more dramatic if I brought the bullet points in rather than just flashing. Okay, next time. So yeah, we're acknowledging, and we've talked about the stock valuations have increased. And again, we're just talking about stocks being elevated, maybe a little bit expensive. So as a result of the fact that things are a little elevated and a little expensive, future growth in the price of those underlying stocks, it should be challenging. And we just talked about the 7-year forecast. That 7-year forecast changes if the market ends up coming down. So please keep that in mind, because we sure do. That's how we're allocating portfolios. And this is the kind of environment where, as you'll see with us, we're kind of like leaning into or leaning away into the market. We, a long-term investor, you know that the market tends to go up about 65 or 70% of the time. It depends, over a very long stretch. So we don't try to guess absolute bottoms and absolute tops, but there's times where we want to, lean away from the market. And this is kind of that lean away environment. And there are certain ways that we've talked about with hedging and quality that we are able to express that. We talk about credit spreads are widening. And this is, we're seeing that meaningfully because it's one of the greatest signs for financial distress. We aren't yet at the point where there's kind of a waving that white flag of surrender, which is our green flag to get in and buy with both hands, but we're watching it. The banking thing we talked about it a lot. It's probably where we spent the bulk of our time today. This is not the great financial crisis. This is a difficult banking environment. I think that we made the case for the commercial real estate environment and how that's going to make things challenging on an ongoing basis. There are going to be certain banks like First Republic that's going to have to deal with massive outflows, and certainly some regional banks that are going to have to deal with massive outflows. We're here to help you, guide through it. I think that, you may want to err on the side of caution with respect to if you've got a bank account that is at a small regional bank and your balances are greater than FDIC limits, you certainly may want to explore working with us. We're happy to help you buy US treasuries and things like that and both reduce your risk and kind of diversify your assets. We just don't want to see you stuck in a bank that goes into FDIC receivership or something like that. So the only silver lining I can give you on the banking environment is that it will end up being deflationary. Again, one of the things that the Fed wants to see is inflation come down. And when you see the banking environment with lending challenges that are happening, and you see the net interest, their net interest margin, the bank's ability to make money on the assets that they have, that's coming under some additional stress. We know that the government's coming with a new program to help create more FDIC buffer. That's going to be another cost that the banks have to pay. So the banking channel has some challenges. This is not the great financial crisis, though. I just want to caution you, though, that when we just can't have a robust economic environment when you lose the banking channel. So there's definitely some concerns that we have there. The market believes that the rate cuts are coming this year. We just don't share that optimism. And when you have a disconnect where the market believes one thing and we think something else is going to happen, that's where disappointment comes in. And disappointment means downside in a lot of cases. And volatility. So the way you pair that volatility, quality, cash flow, hedging, those kind of things, you can always call and ask us and say, do I have enough hedging? Do I need more hedging? Do I need more quality?
Right.
And those are things that we're looking at on a macro level and on a micro level for clients. But if you've got questions, hit us up, send us an email.
Yeah.
Call Bhavna, don't call me. I'm just kidding. Call anybody here at the office. We're all there. And so that's that last.
You'll be better off calling me than Michael.
Oh, I know. It's true. Well, also, I'll be flying today too. Don't forget that. So,
I do see a question trickling in about the debt ceiling negotiations. Are we concerned? We are always concerned about political incompetence, and that, applies to so many different things. And I would basically position that as one of the potential, would something break category for the Fed to be watching out for and for us to be watching out. So yes, that's definitely something that we are paying attention to, and everyone, including the Fed, would be paying attention. So we have the ongoing banking situation that could possibly be another, would something else break? And we have the debt ceiling, as I would put it, in that category as well.
I feel like we got most of the questions, though. Do we have to answer the one other than that, Ms. Lincoln? How was the play? I mean, it's funny. It's funny. I give you bonus points for being humorous. Yeah, I really feel like we got through most of the questions. I mean, it's certainly an environment where firms like ours, this is where we earn our money. This is where we earn our money. This is where we earn our fees, where we are actively looking at all those different risk reduction strategies and quality strategies. And just this is not the environment where you can be at Vanguard and just own the S&P 500 and hope for the best, or just own a bunch of indexes. this is where active management becomes super critically important, and we're happy to bring that to you. So,
On that
did we do
note,
it?
Yeah,
I think we
we
did.
did.
I think we did it. Thank you so much for your time and attention. We look forward to seeing you next quarter. If you need anything, please let us know. We'll be posting this recording. I don't know. Give us a couple of days. We'll go ahead and make that happen. Thanks, Bob. That was awesome.
Thanks, Michael. This is fun.
I
Yeah.
like taking it first.
Yeah,
Yeah.
I was gonna say the same thing. We have to do these in person every quarter.
And you can fly to Scottsdale next time. All right. Thanks again. Take care.
Bye.
Bye.